preparing for a finance, lending, and mortgage operations at Wells Fargo India WFIP interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the end-to-end lending life cycle and where an operations team adds value. The interviewer wants to assess whether you can connect front-end lending activities with back-office execution, controls, customer impact, and the risk-focused operating model expected in Wells Fargo India roles. While answering, focus on application intake, underwriting support, documentation, loan booking, servicing, collections, closure, SLAs, exception handling, and how operations teams protect accuracy and compliance. A lending life cycle starts with application intake and eligibility checks, then moves to underwriting, approval, documentation, booking, servicing, collections, and closure. In an operations role, I'd focus on accurate data capture, document validation, credit condition tracking, and timely handoffs between teams. At WFIP, the key is not just processing volume, it's controlling risk, meeting SLAs, escalating exceptions early, and ensuring the U.S. business has clean information for customer and regulatory outcomes. Question 2. What is the difference between mortgage origination and mortgage servicing? The interviewer is testing your understanding of the mortgage value chain, especially whether you can separate loan creation activities from post-closing account administration and customer support responsibilities. Make sure to cover application, underwriting, closing, funding, payment processing, escrow, payoff, investor reporting, default management, and the different operational risks in each stage. Mortgage origination is the process of creating a new loan, from application through underwriting and closing. Servicing begins after funding and covers payment processing, escrow administration, payoff requests, investor reporting, and default support. I'd keep the distinction clear. Origination is about eligibility and collateral validation. Servicing is about accurate account management. In both, the operational priorities are data quality, compliance timelines, clean documentation, and quick resolution of borrower exceptions. Question 3. How do DTI and LTV influence a mortgage lending decision? This question evaluates your grasp of core mortgage risk metrics, borrower affordability, collateral coverage, and why operations teams must validate calculations and source data accurately. In your answer, talk about debt to income, loan to value, income verification, property valuation, credit risk, mortgage insurance, approval thresholds, and downstream impact of incorrect inputs. DTI measures repayment capacity, borrower debt obligations divided by qualifying income. LTV measures collateral cushion, loan amount divided by property value. For example, a $240,000 loan on a $300,000 home has 80% LTV. I'd use DTI to judge affordability and LTV to judge loss exposure if the loan defaults. Strong operations teams calculate and verify both consistently because small input errors can change approval, pricing, insurance, and risk outcomes. Question 4. What is loan boarding, and what checks would you perform before a loan is boarded? The interviewer wants to assess your knowledge of post-closing setup, system accuracy, document validation, and the controls needed before a loan enters servicing or accounting systems. Be sure to mention borrower details, loan terms, interest rate, payment schedule, escrow setup, collateral information, investor codes, document completeness, reconciliation, and maker-checker review. Loan boarding is setting up a funded loan on the servicing system, so payments, interest, escrow, statements, and reporting work correctly. Before boarding, I'd verify borrower identity, loan amount, rate, maturity, payment due date, property details, escrow flags, investor information, and closing documents. I'd also reconcile source documents against system fields. If boarding is wrong, the borrower may be billed incorrectly, accounting can be misstated, and regulatory issues can follow. Question 5. Which mortgage documents are most important for operations review, and why? The interviewer is testing your familiarity with mortgage documentation, your ability to identify critical documents, and your understanding of how missing or inaccurate documents create legal, credit, and servicing risk. While answering, focus on promissory note, mortgage or deed of trust, closing disclosure, title, appraisal, insurance, income documents, tax records, and document exception tracking. The promissory note is critical because it evidences the borrower's repayment obligation. The mortgage or deed of trust secures the property as collateral. I'd also review the closing disclosure, title documents, appraisal, insurance proof, income documents, and tax records, depending on the process. My focus would be completeness, consistency, signatures, dates, and matching system data. Missing documentation can affect enforceability, servicing accuracy, investor sale eligibility, and audit results. Question 6. A borrower payment does not match the expected monthly installment. How would you investigate it? This question evaluates your exception handling approach, reconciliation discipline, customer sensitivity, and ability to identify root causes without jumping to incorrect adjustments or escalations. Make sure to cover payment history, due amount, suspense accounts, late fees, escrow changes, partial payments, misapplied funds, system notes, customer communication, and escalation protocols. I'd first compare the received amount with the scheduled payment, including principal, interest, escrow, fees, and any past due balance. Then I'd check payment history, suspense activity, recent escrow analysis, rate changes, late charges, and prior adjustments. If the amount was misapplied, I'd follow correction procedures with approval. If it is a partial payment, I'd handle it per policy. The aim is to protect the customer, avoid aging errors, and keep servicing records accurate. Question 7. Explain escrow in mortgage servicing and the common issues operations teams handle. The interviewer wants to assess whether you understand escrow mechanics, tax and insurance obligations, borrower billing impact, and the operational controls around disbursements and annual analysis. In your answer, talk about collecting monthly escrow, paying property taxes and insurance, shortages, surpluses, annual escrow analysis, disbursement timing, and customer communication. Escrow is a separate component of the mortgage payment collected to pay property taxes, homeowners insurance, and sometimes other property-related obligations. Operations teams monitor escrow balances, process disbursements, complete annual analyses, and handle shortages or surpluses. For example, if insurance premiums rise, the monthly escrow payment may increase. I'd ensure calculations are supported, disbursements are timely, and customer notices are accurate, because escrow errors quickly create complaints, penalties, and regulatory risk. Question 8. What happens operationally when a mortgage becomes delinquent? This question evaluates your understanding of delinquency stages, customer outreach, loss mitigation support, reporting accuracy, and the controlled handling of default-related mortgage processes. Be sure to mention days past due, notices, collection outreach, payment arrangements, loss mitigation, forbearance, foreclosure referral controls, investor reporting, and compliance timelines. When a mortgage becomes delinquent, the account is tracked by days past due, and servicing teams follow defined contact, notice, and reporting requirements. Operations may support payment research, document collection, loss mitigation packages, forbearance updates, or investor reporting. I'd be careful with timelines because default servicing is highly regulated. The goal is to help the customer where possible, keep records accurate, avoid premature foreclosure actions, and ensure every step is evidence-based. Question 9. Why are regulations like TILA, RESPA, TRID, and HMDA important in U.S. mortgage operations? The interviewer is testing your compliance awareness, especially whether you understand that mortgage operations involve regulated disclosures, fair lending data, timing rules, and audit-ready processing. While answering, focus on transparency, borrower protection, disclosure timing, fees, settlement practices, reporting data, fair lending, documentation, and why offshore teams must follow U.S. process controls. These regulations protect borrowers and create consistency in mortgage lending. TILA focuses on credit cost disclosures. RESPA covers settlement practices. TRID combines key disclosure requirements, and HMDA supports fair lending and market monitoring through data reporting. In an operations role, I don't need to be a lawyer, but I must follow procedures, validate data, meet timelines, and document exceptions. A small processing delay or incorrect field can become a compliance issue. Question 10. How would you perform quality control on a lending or mortgage operations process? This question evaluates your control mindset, understanding of maker-checker processes, error prevention, sampling, root cause analysis, and continuous improvement in a high-volume banking operations environment. Make sure to cover checklist-based review, source-to-system comparison, critical fields, peer review, defect categorization, feedback loops, trend analysis, and remediation of repeat errors. I'd start with a clear checklist tied to the process risk: borrower details, loan terms, dates, documents, approvals, and system entries. Then, I'd compare source documents to system data, review exceptions, and ensure maker-checker evidence is retained. For recurring defects, I'd categorize them by root cause: training, unclear procedure, system issue, or workload pressure. Quality control should not be a tick-box exercise. It should reduce rework, customer impact, and audit findings. Question 11. Give examples of operational risks in lending operations and how you would control them. The interviewer wants to assess your ability to identify process failures, data inaccuracies, fraud exposure, compliance breaches, and practical controls aligned with a large bank's risk culture. In your answer, talk about incorrect data entry, missing documents, unauthorized changes, missed SLAs, duplicate payments, privacy breaches, segregation of duties, reconciliations, and escalation. Operational risks include incorrect loan setup, missing documents, misapplied payments, missed regulatory timelines, unauthorized changes, duplicate disbursements, and data privacy breaches. I'd control these through maker-checker review, system access controls, reconciliations, exception reporting, procedure adherence, and timely escalation. For high-risk fields like interest rate, maturity date, and borrower identifiers, I'd expect stricter validation. In a Wells Fargo environment, I'd also document evidence clearly, because controls must be demonstrable, not just performed. Question 12. Which KPIs would you track in a mortgage operations team? This question evaluates whether you can think like an operations manager, balancing productivity, quality, timeliness, customer impact, compliance, and process improvement, rather than only task completion. Be sure to mention volume processed, SLA adherence, accuracy rate, defects, rework, aging, turnaround time, backlog, escalation rate, first-time right percentage, and customer impacting errors. I track both productivity and risk indicators. Key KPIs include volume processed, SLA adherence, turnaround time, accuracy rate, first-time right percentage, defect rate, rework, backlog aging, and escalation volumes. For mortgage processes, I'd also separate customer impacting errors from internal corrections. A team can process high volumes, but still create risk if quality is weak. The best dashboard shows whether we are fast, accurate, compliant, and improving over time. Question 13. If your team has a sudden spike in work volume and SLAs are at risk, what would you do? The interviewer is testing your prioritization, stakeholder communication, workload management, escalation judgment, and ability to protect critical controls under pressure in a banking operations setting. While answering, focus on triage, risk-based prioritization, aging analysis, capacity review, cross-training, overtime approval, stakeholder updates, SLA transparency, and not bypassing controls. I'd first quantify the backlog by age, process type, risk level, and SLA deadline. Then I'd prioritize regulatory, customer-impacting, and high-value items before routine work. I'd discuss capacity options such as cross-trained resources, shift adjustments, or approved overtime, while keeping maker-checker controls intact. I'd also update stakeholders early with realistic recovery timelines. Under pressure, the mistake is to chase volume blindly. I'd protect quality and compliance while clearing the queue. Question 14. How does a mortgage loan impact the bank's financial statements? This question evaluates your finance fundamentals, ability to connect lending operations to accounting outcomes, and awareness of interest income, fees, reserves, and balance sheet classification. Make sure to cover loan asset recognition, interest income accrual, fee treatment, escrow liabilities, credit loss allowance, charge-offs, and how operational accuracy supports financial reporting. When a bank originates or holds a mortgage loan, the loan is recorded as an asset because the borrower owes future cash flows. Interest earned becomes interest income over time. Certain fees may be deferred and recognized over the loan life, depending on accounting rules. Escrow balances can create liability accounting because funds are held for taxes or insurance. If credit risk increases, the bank may need an allowance. Accurate operations data directly supports financial reporting. Question 15. How would you demonstrate Wells Fargo's risk and customer mindset when handling a process exception? The interviewer wants to assess cultural fit for WFIP, including accountability, customer focus, ethical judgment, escalation discipline, documentation quality, and willingness to follow controls even under pressure. In your answer, talk about understanding the exception, checking policy, protecting customer impact, documenting evidence, escalating timely, avoiding unauthorized workarounds, and learning for root causes. I'd treat an exception as both a customer issue and a control issue. First, I'd understand the facts, review the procedure, and identify whether the customer, financial reporting, or compliance timeline is affected. I would not use informal workarounds or make unsupported changes. I'd document evidence, escalate to the right owner, and track closure. After resolution, I'd look for root cause so the same issue does not repeat across the queue. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.